Hey, welcome back into our podcast. Today we are joined by one of our favorite mortgage brokers, Elena Boland. She was Wholesale Mortgage. She's helping us educate everyone out there about the various topics that are out there for mortgages.
Right.
So another one that comes up quite a bit that is asked by our buyers are, what is the difference between a HELOC and a second mortgage? What does the HELOC stand for? That's the first question.
Acronyms, tons of them always.
Tons of them.
Right. Home equity line of credit. So it's just a line of credit against your home.
Okay, so you're already on the home. How does it work?
You can use a HELOC to help purchase a home, or you can pull it out as a mortgage in first or second place on your current home that you do own.
So you use that for what? Do you use that to pay off debt? What's in your line of business, what do most people use that for?
Right now, the most common thing that we're seeing people utilize home equity lines of credit for are home improvements, paying off high interest rate debt, or to gift to other family members for their down payments that are needed.
Excellent. And then what's the second mortgage? We see that a lot. Apparently, I guess you'll expand upon this, but you can avoid a jumbo mortgage by doing a second mortgage. I know we haven't been doing too many of those in the last 5 years, but they're back. Tell us a little bit more about second mortgages and how they can benefit some of our buyers.
So there's two second mortgage product types, the HELOC that we covered or a fixed second. Both are definitely advantageous for certain situations. So if in our county someone has a loan that exceeds the county loan limit of $647,000.
That's conventional.
Yes.
Correct.
And they don't want to pay the higher jumbo interest rates. Then they can get a first mortgage for $647,000 and then a second mortgage for $100,000 or whatever it is they may be seeking. You do have to watch out for loan to value restrictions, but you can get a conventional loan and a home equity line of credit with 5% down and end up borrowing 95% of the value of the property or the sales price of the property. You can do that with the home equity line of credit as well. That is advantageous more so for people that tend to be maybe selling a home and they just need the second mortgage until a home is sold.
Yep.
And then they can pay off that home equity line of credit, get it down to zero, but then they have the ability to reuse that one. So that's a big difference between a fixed second and a home equity line, is the line can be paid down and reused multiple times over the first 10 years that it's amortized over.
Another question we get about this topic is, are you avoiding mortgage insurance when you get a second?
Absolutely. So if you put less than 20% down, you have to make sure that your loan officer structures the loan in a way that you do not pay mortgage insurance. And sometimes that is the goal of buyers, because if they see that they're putting 5% down and they're paying that monthly fee of mortgage insurance, it's tough sometimes to stomach that the fee is just going to a bank's reserve and it's never going to go anywhere into the interest of your home and never going to pay it down. So if you do get a fixed second, of course, as you pay on that loan, then your balance is going down and you're contributing back to yourself.
Great discussion. Thanks for coming in. Stay tuned for some more videos out there. Take care.